Hello, my name is Jingonelli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
Would affect the auditor's decision in either to qualify the audit report or not to qualify it. Okay, so it has an impact on the audit opinion that is going to be given by management, by the auditor. Normally, when I am talking about materiality, I like asking people, if you dropped 1,000 shillings, will you move all over campus looking for that 1,000 shillings? Would you decide to chop a lecture looking for 1,000 shillings? Or would you be so demotivated to attend a lecture because you've lost 1,000 shillings? But then how about if you lost a bundle of 5 million shillings? Would you be demotivated in a way that you won't attend your lecture because your spirits are low? Yeah. So someone is saying, yes, the economy is hard. With 1,000 shillings, they can be so demotivated and they don't attend the lecture. Yes. That is Boris's. Now, what I need to tell you is that materiality is relative. What is material to Boris may not be material performing audits. What is material to company A? Material misstatement to company A may not be material misstatement to company B. So materiality is relative of materiality set in an audit. There is what we call materiality for the financial statements as a whole. You look at it, you set a materiality level and they say anything that is 10 million and above in respect to these whole financial statements is material. So if there is an error or an omission that is above 100, rather 10 millions, or a misstatement in terms of a disclosure that is above 10 million shillings, if it does not correct that mistake at the opinion stage, this can be considered to change your audit opinion. What do I mean? That if, for example, there was in the provisions there was an understanding for the financial statements as a whole. It is not a particular class of
recording in progress.
Any transaction that affects going concern. For example, the bank decides to pull back the loan that it had given. These plans, you need to be careful showing off. You look like Tata Keila, you're drinking beer, you're putting on your video, you're interested in seeing you drinking beer this early morning, wine that is expensive. I think the beer you're taking is than 5,000 to take it, but at least take off your video. Okay, don't be so remote. Okay. Yeah. So some unusual transactions most of these to exist the way they are. Some guidelines that we follow, and this guide auditors while setting these materiality levels used revenue, assets, and expenses. So what does it mean? 5% and above of PBT is considered to be material. Okay, and where do you use it? Where do you use this benchmark? Is normally recommended where you're looking at a profit-oriented that has low tax, has low assets. The asset base is not big. Yeah. For example, you're looking at the bank or you're looking at the bank. The assets are not that big, but the profitability is big. They are basically generating profits, and their profits are always big. Then the other benchmark is revenue. Anything below 0.5% of revenue is immaterial. Anything above 2% of revenue is material. Yeah, so any statement that is above 2% of revenue will be considered as material. So in between 0.5 and 2 can be material and immaterial. So the auditors can place their materiality level at 1 or 1.5. Okay, so but they won't go below 0.5. Where do we use this? We use this where, yes, it's a profit-oriented business, but the profits generated are volatile in a way that they are not stable. No, today they are making a big loss. The other time they make a big profit, then they go back to a big loss. You know, it's not stable. And when you're placing your materiality, it should be on a benchmark that is kind of stable. Okay. Then we have another benchmark of total assets, where we have the range of 1 to 2. So anything below 1% of total assets is immaterial, and anything above 2% of total assets is considered to be material. Now, where do we use it? We use this with entities with high total assets, but low profits. For example, in the real estate business, where these guys are selling, they build and sell. They have the total assets. The assets are big. The amounts are so huge by their nature, but the profits are not necessarily a lot, okay? So you can set your range between 1.5, depending on how you've understood the business, yeah. Then total expenses, the range is 0.5 to 2. Anything below 0.5% of revenue of expenses is material, and anything above 2 would be material. So anything that falls between 0.5 as an auditor, you can place the level at 1, 0.5. Where do we use it? In the public sector or non-for-profit making entities. Because these ones, profit is not an issue. Is normally affected by your understanding of the business.
Recording in progress.
Okay, of my revenue is immaterial. Then anything above 1% will be material. So these are guidelines, not that our auditors will follow, but it will be within those ranges, but it will be based on their understanding of the entity, because most of these things are professional judgment. Is it okay, Eunice? Okay.
Excuse me, sir.
Yes, Eric.
Please, I beg your pardon on the revenue part.
What is?
I don't understand that.
What is wrong with it?
I don't understand.
What haven't you understood? It's a benchmark. I need to know what you've not understood.
This part of profit-oriented entities where profit before tax from continuing operations is volatile.
Yeah, volatile means that you have two things. You have the PBT and the revenue. But where you find that the PBT is not stable, yeah, it is fluctuating every year and with very big spikes, big losses, then the following year they make big profits, then they go back, that means that it cannot be a better benchmark, right? Because it is not stable. So you opt to now use for revenue. Are you getting it? Because you found that revenue is more stable. So if you're given to choose between volatile PBT and stable revenue, you would go for stable revenue. Is that clear?
Yes, I get it.
Yeah. So Rachel, you're saying that if an individual item like inventory is at 7% and the performance maturity level is at 8%, do I consider it immaterial? Yes, you consider material, but at least you're not leaving out something that is now 8 because you had initially taken 10. Yeah. So Hassan, you asked that when cumulative immaterial amounts tantamount to when, for example, when you accumulate or you aggregate immaterial items, yeah, and they end up being above the set materiality level, right? You are allowed as an auditor to adjust your performance materiality level altogether. But following your professional judgment, you can choose to consider this item Barbara Kamoli, please mute your mic. Barbara, mute your mic. Thank you. So I'm saying that I was responding to us to Hassan and also now that you aggregate these immaterial items and they give a big amount, yeah, above the mass, you can ask management to adjust. They will become now material. Okay, something that so you have to keep adjusting. No, you don't have to keep adjusting, right? But you have to keep on check, you have to, for example, you can adjust your materiality, your performance materiality for revenue. You adjust your performance materiality for expenses. You get, for example, you say that for this particular class, this is the level we're going to take. For this one, this is what we're going to take. You get it. So it's not necessary that you're going to keep on adjusting, but you must always have an open mind. Okay. I don't know whether that answers it. Let me give an example. Let me show you with this example. Below are figures extracted from the financial Bitabuse Limited, small company owner managed by Bitabuse, who owns 80% of the shares, but the company also has a bank loan of 40 million shillings. Okay, so you are given these figures for over 3 years. You can see revenue in 2019 was 210 million, 260, 250. The gross profit, the same. Operating expenses are there. TBT is there. Then we're asking to set the materiality and material qualitative data. You have to look at who are the main users of this finance, because the main users determine, they also have, and they're also a factor that you use when you're determining the materiality. So here, the main user is Bitabuse, 40% of the business, and also the bank that gave out a what? A loan. Yeah. So now, When you look at that as the auditor, now you have to set the materiality, but now you have to use your what? Your judgment. Where do I place it? Do I place it on PBT? Do I place it on revenue? Do I place it on expenses? Do I place it on total assets? Where would you place it? Now, one, you look at PBT. When you compare 250 million in 2021, and out of the 250 million, you get a profit of 10 million, 10.3 million. That profit is so low. Yeah. Again, when you look at the stability, you see the revenue is kind of stable, 210, 260, 250. Yes, there's a dip, but not that big. But when you look at PBT, 26 million in 2019, 23 million in 2020, then it dips significantly by half in 2021. That it's so volatile. You look at the assets, 73, 113, 158. This is a small business. This is also volatile. So you find that revenue is more stable, right? Revenue is more stable, but the benchmark of revenue you see is between 0.5 and 2. So you wouldn't say that you're setting your materiality at 2, meaning that anything below 2 is immaterial and anything above 2 is material. So you set your materiality between 0.5 and 2. So because you're looking at this company being small, professional, you say I'm putting the materiality level at 1% of revenue. Are we together? You've chosen your benchmark as revenue, but also given a range of 0.5 and 2, you've chosen to place your materiality at 1%. So meaning your financial statements, the materiality at the financial statements will be 1% of 250 million in 2021, because it implies that reality at the financial statement is now 2.5 million. So again, using your professional judgment, then you say that now I'm setting my performance materiality at 2 million, which is about 80% of the financial statements materiality. So that is how you look at it. So the professional judgment has to come in. You look at the size of your business. So you compare, you choose where to place it in the ranges. Then you also decide on which benchmark I can use. Is everyone having issues with my network? Can you all hear me? Or is guys, can you hear me properly?
Yes.
Yeah.
Okay. So I think Rachel, you have something wrong with your network. Okay. Yeah. So the materiality. Someone was asking a question: how do you determine a small company and a big company? I think that is easy to understand. A small company, you can look at a small company based on revenue, and you can look at a small company based on assets, and you compare the industry that they are in. For example, when you compare, when you look at the banking industry, right? Is I&M, I&M or Orient Bank, is it big in Uganda? I want to ask someone here. Is it a big bank?
No.
It's not a big bank. Why do you say it's not a big bank?
No, it's not.
Good morning, sir. You can hear me?
Yes, I can hear you, Mansoor.
Yes, I think that's kind of, for one to say it's not a big bank, it's uninformed. because we just people look at what they think are the popular banks and assume that those are the bigger banks. Yet from what you say, sometimes it's okay to look at the revenue and maybe the assets that these particular entities own, which at this particular moment, most of us have no knowledge about. So it would be uninformed for us to be here and say it's not a big bank or it's a big bank, I think.
Yeah. But now as an auditor, now Mansoor, when you are an auditor, auditing, you're going to audit I&M as a bank. Of course, you'd have gotten an understanding of their revenue, like you said, and their assets. And you compare with the industry, right? So you may find that their contribution, the contribution of their revenue is like 1% of the whole industry or 0.5% of the whole industry. That would be basis for you to say that, oh, now this one is a small one, a small bank. Yeah. So that is how you can assess. You don't just wake up and say, no, it is small. No, there are benchmarks that you have to look at. There are comparisons that you have to look at best compared to the other people in the same industry. Okay. Okay, so Sheila is saying it has few branches. Yeah, it can have few branches, but when its revenues are up there, having few branches is a strategic move. In business management, it's a strategic move. I might have a niche of only corporates, yeah, and I don't want to go to the villages. For example, do you think Citibank is small? Citibank, do you think it's small? No, it's not small. Do you think Standard Chartered is small? It isn't small, but those have few branches, you get. And people have gone into automation now. Now we're talking strategic management. People have gone into automation now. My strategy would be that I'm going to automate my systems. I don't need branches. All I need is people to come. You apply only a bank account. Then I use your card to your premises. I don't need a branch. I means of withdrawing, of moving money, electronically, 20 million. I only leave like 2 branches for people who want to do cash, who want to go over the counter. Those are strategic moves. Then you have a bank like Centenary Bank. For it is targeting people like, I wouldn't want to say informal people, but okay, let me say the informal. You get what I'm saying? So for them, they will go out there, they will set up branches in the villages, farmers, you get. So it's a move that one will take, but it doesn't mean that that person is going to be small. Like saying that everyone who is driving a big car is rich and that person who is driving a small car is poor. Some people just show off, like this person who was showing off with beer. Do you think he's the richest guy here? Is he richer does he have more money than the rest of you? No, that's pompous.
Even has worms in the stomach.
I don't know about that. Now, purity, you're saying you're inquiring, is the choice of the benchmark dependent on the stability? Stability can be one of them, but even the size of your client can influence the choice of the benchmark. For example, where your client has been posting losses, you may not want to put the benchmark on PBT. You're better putting it on, or you better put it on your revenue. For example, where your client is in the real estate business, it's proper to put the benchmark on revenue because they don't really sell that much. And it's not also proper putting the benchmark on profits. But they have a lot of houses and land, yeah? So those are assets. So you're better putting the benchmark on the assets. So there are many things that come into play before you choose a benchmark. I don't know whether I've answered your question, Purity. Purity, have I answered your question? Okay, that is it about materiality. Okay. Yeah. So we did understanding of the entity. You remember when we said you look at the entities, operations, the industry, the nature of the entity, the accounting policies, the objectives. Yeah, we looked at those in the first lecture. So any questions, guys, before we go to the audit procedures? Tata Kaida. Your beer is not a problem, Sebo. But it is the audience. It's where you're doing it. Continue taking, but not on video. Okay, audit procedures. And you all know that the audit procedures that we're talking about are those that will help you generate audit evidence. Yeah. And like I told you, that when you don't get sufficient audit evidence, you can't come up with an opinion, an appropriate opinion. And when you don't come up with an appropriate opinion, then you are exposed to audit risk. Yeah, you are exposed to audit risk, and that will be very dangerous for an auditor. So these are some of the audit procedures that we use in auditing. Some of them, okay. Let's start with inspection of records and physical assets. Because your job, by the way, audit procedures fall in the field stage. Okay. So when you are auditing and you want to get more evidence, you examine the records of the business. You get these documents like minutes, accounting manuals, HR manuals, major contracts with clients, loan agreements, sales invoices, vouchers, the payroll, employee contracts. You inspect those documents, those records, and examine them to get more information about what is happening, to look out for if there's any misstatement, anything that does not conform with the regulations, You also inspect physical assets. For example, if a company says they have 5 motor vehicles, you have to physically at those 5 motor vehicles. Do they exist? Are they in good condition? You may find that they are there. They say they have 5, but the 3 are at the farm of the chief administrative officer, the cow. Back in the days when we were still auditing for the government, they expanded the office of the auditor general. They used to subcontract other audit firms to do audit on their behalf. So you would go to the local government like in Chenjojo, and they're supposed to have six pickup trucks. But when you find, you spend there like 3 weeks, but you only see 1 pickup truck. And what happens? These trucks are fetching firewood in all their animal feeds in the farms of the chief administrative officers, which is not right? So when you are doing your audit procedures, you need to inspect records, documents, these assets. For example, vehicles, you would want to see the logbooks. You'd want to see any document in case the assets are being held as collateral by the banks. You need to see the loan agreements. Okay, so inspection of records and physical assets is very crucial for Is not crucial for, rather is very crucial when you are trying to extract audit evidence. The other procedure is observation. This is basically watching how processes are being performed, watching how things are being done. For example, an auditor, you can attend and observe a stock take. You know, a stock take or inventory count, you know, like you go into a supermarket, you know, and you see how they are doing their stock take. Are they following instructions? One of the key instructions when a stock take is that there should not be any stock movement. There should not be any stock coming in. There shouldn't be any sales. I don't know whether you've observed situations where you go to capital shoppers and you find they are closed for the day. During that time, they are doing stock take. So they write the first instruction when you're doing stock take is there should not be any movement of stock, both in and out. Okay? Yeah, Lucas, tell I need to help me with her child, Aaron. Okay? Then the other thing is when someone is being paid their wages, do they sign? Do they present identification, you know, the hours worked? Is the payment being done based on hours? You know, who is actually paying? Yeah, is money paid out in the open? You get, so you have to sit and observe to get more audit evidence. However, the audit evidence you get through observation may not really be on itself so reliable, because people behave differently when they. So the evidence you get through observation should be collaborated with other evidence that you collect using other procedures. The other procedure is inquiry. You're basically obtaining in the entity and outside the entity. You know, like, yes, you know, like, yes. A minute, please. Yes, Lucas. Not it. Yeah, sorry about that. So we're talking about inquiry, that you try to obtain information from people within and people outside. However, this also has its own challenge. So the people that you try, for example, you get information from people in the accounting department, because when you do, the main information is coming from the accounting department. You get information from management if there's any suspected fraud, any unusual events, any risks of going concern, you know. You can also get information from the internal auditors on whether the financial statements are really effective, you know, and whether these people are implementing his recommendations. You check out with the lawyers whether there's any pending court case, chances of losing to the sales team, whether there's any threat to losing a particular client. This will also not be so reliable, because in most cases, people tend to lie. For example, if you ask management, are any possible fraud, when they are themselves the ones involved in fraud, they may not tell you much. Are we together? So the first we looked at was inspection of documents and assets. Then we looked at observation, then inquiry. Then there's what we call reperformance. like you independently carry out procedures or controls, like trying to check how effective the internal controls are, you do a reperformance. For example, if you want to confirm that bank reconciliations are done promptly and they are well reviewed, and they are done the way they are supposed to do, you can choose to reperform like a reconciliation for June and that one for December. You can reperform it, okay, to confirm whether it is actually done the way it's supposed to be done. Or you can do a recount of inventory. When you do a reperformance, you're trying to confirm what those people have already done. Have they done it the right way? Is the bank reconciliation, because in bank reconciliation, accountants are funny. They will force it to balance. The way you force it to balance in exams, that is the same thing you're going to do in practice. It will fail to balance. Money has, but because you can't trace the check anywhere in the records, so you force it to balance. So when an auditor comes, he will pick like maybe March, June, September, and December. They do a reperformance on their own. So you can't be an auditor when you don't even know how to do a bank reconciliation. So guys, if you want to become auditors, please just ensure that you know things, okay? Then the other and what people consider to be the most reliable is external confirmation. This is a process of where you obtain direct written audit evidence in paper form, electronic form, or by any other media, but where the third party who you're trying to confirm from is responding directly to the auditor. You're trying to get information from someone external to the business, and that person responds directly to the auditor, not to management of the business. For example, if the company says we have a data called Muhammad Sebali, Muhammad owes us 500 million shillings. The auditor is going to get a headed paper for the company, get my address as Muhammad Sebale. They write, the management writes saying, "Dear Muhammad Sebale, we are in the process of auditing and our auditors, KPMG, would like to confirm the balances you owe to us. By our records, you owe us 500 million shillings. Please check the box, tick the box if you're in agreement. If you're not in agreement, share your figure." Any response, the response is to be made to the auditors. So when I get that letter as Muhammad Sebali, and my figure is 300, because I paid 200 million shillings, I will say, my records show I owe you 300 million shillings. And my response is not I don't send the response to the management of the company. I send the response to KPMG, the auditors. Are we together? So the auditors will have more reliable information because they are getting it from me as an external person, not from the management of the business. Those are what we call third-party confirmations. They are done with banks, they are done with trade creditors, they are done with trade debtors, they are done with lawyers. Okay? Those are external confirmations. Then we have recalculations. Recalculations are like the reperformances. You're trying to confirm mathematical accuracies. You can get and you cast, you can recalculate depreciation, because sometimes people will do 10% of the cost, then they get a weird figure. Okay, so you can recalculate depreciation, you can recalculate provisions for bad debts, using IFRS 9 analytical procedures. You're trying to evaluate the financial relationship between items or between financial and non-financial data. How do we do it? You can compare, but for different year one. You can compare actual information with a budget. You can compare the with what you expected in the bank compared with the prepared by the human resource.
Recording in progress.
You need extra much of the family. You need extra. So these process, I think you're in twice. You need to mute one of them. So these procedures are basically dependent on the account balance you are auditing. And Eunice was also asking, do they follow each other? No, they don't follow one another. These, you apply them based on the account balance. In, I think, topic 6, audit of financial statements, we shall show you how you apply these audit procedures, yeah? But they are dependent on a particular class of account. I don't know whether I've answered your question, Mansoor.
Yes, why I asked it well is we currently have an ongoing audit at the firm I work with, and you find that our auditors, it's an ongoing sentient, and our auditors, basically what they've done so far is ask for samples. We use they ask for samples, for example, the account receivables listing, opening trial balance, the bank statements for the year, or the bank reconciliations for the year that ended December 2021. Now, I have an issue with observation. They have not come on ground to be able to, because you mentioned about observation, see how we really do most of these particular processes. When you look at external confirmation, yes, we've been able to get here we call them related party confirmation, or that are sent out to most of these, maybe particularly to our parent company in Kenya, where they had to confirm the balances on the bank account, which was okay. But on the observation bit, that they haven't done, because most of the work has been done electronically. For samples, you share. That's it. For these particular samples, you share feedback. That's how it has been. So I'm trying to imagine, what would an auditor really be able to obtain sufficient appropriate evidence if they indeed missed out on some of these particular audit procedures?
Mansoor, you see, with observation, you observe processes. An auditor observes processes. For example, they will observe how you do your stock take. So depending on your operations, they find that some of the procedures are not appropriate. Are you getting what I'm saying? So I don't know what kind of business that you're in. Shakila Navidie, please mute your mic. Yeah. I hope, please mute your mic, guys. Let us be civilized. Yeah. Let us be civilized, honestly. Now, I don't know your kind of business, but the observation is done with seeing how processes are processed. So you find that when they realize that for example, you do your laborers that you pay, so they realize that there's nothing to observe there. So share those documents electronically. And you know why that is the case? We have changed mode of working ever since we got into this COVID pandemic. Yeah, auditors realize that they can audit with minimum contact. Just share the information they request for, because I know if I share them with them your trial balance, then they ask for some ledger listings, then they will pick out particular transactions. They'll ask, we need particular purchase, we need supporting documents, particular sale, we need for this payment that you made. You get those. There are any questions in inquiry, right? Then back on their side, they are also doing analytical procedures. You get what I'm saying? So not all these procedures will be applicable to all businesses. Mansoor,
yes,
are you
yes.
with me?
I now appreciate probably why they didn't opt to do the observation bit, because we're into relocation services, immigration services, expatriation, and all that. So probably they didn't feel that they should be here, because most of these services, even when they are offered to clients, when they are putting in these estimates or requests, they are done electronically. So they didn't maybe feel like they should be here.
But they will do the others.
Thank you so much.
Like the inspections, the inquiries. I know they call you and they want to confirm some things. They do the analytical procedures. Yeah. So and by the way, that's why most auditors get it wrong, because they will perform procedures that are not really necessary, and then they will end up not getting what they're supposed to get. Okay. Okay, Captain, do you have any question? Captain, I don't know. Any other question, guys? Let me see.
Excuse me, sir.
Yes, sir.
What if the third party you run to for assistance or in accuracy is a buyer? Is buyer? And you don't realize with your auditing staff, does it mean that you have to go back to the
yeah, you see, like I mentioned, some of these procedures may not be conclusive for evidence, right? Because they may be some manipulation. For example, when you confirm, yeah, and we are going to write to you, but you know what? In our records, ourselves out. You get that is there. It happens, and that is why audit cannot give you absolute assurance. You get what I'm saying? Because there are some things that you may not be in a position to do what? To manage. Okay. So you are supposed to collaborate evidence gathered through one procedure with what you got from another procedure. Okay. I think I've answered your question. Rachel, you're saying is reperformance different from recalculation? Yes. Recalculation, you're trying to confirm additions and subtractions. Yeah. Reperformance, you are redoing the whole thing. Okay. You're redoing the whole thing. Yes, Tata Kayla, you're asking, on what basis does an audit determine external confirmations? Are they on auditor's decision or company's decision? It is the auditor's willing to obtain third-party confirmation because the auditor believes that he will get more evidence reliable when they confirm from a third party. So what happens and the client? So the audit firm tells the client that one of the audit procedures we shall do is we shall have to contact your customers, your bankers, your lawyers, and your creditors. But it is the management, it is the company to write to their clients. The audit firm does not write to their clients. The management writes to their clients, to their lawyers, to their bankers, to their creditors. Because, for example, the bankers cannot give account information to another person other than their client. So when you audit, when you start about audit of financial statement, we shall show you a sample of an audit confirmation later. When you write, you're writing as, for example, Muhammad as the Chief Operations Officer at AR, I'll write to the bank, Standard Chartered Bank, and I tell them our auditors we are in an audit process. They seek to confirm the balances we held as at 31st December 2021. Kindly respond directly to our auditors, KPMG, on this address. You get what I'm saying? So when the Standard Chartered Bank is responsible, but it is upon my request. So as an auditor, you cannot request for information from a third party linked to a client without their consent. Tata Kaila, that is okay. Chief,
it's okay. It's okay, sir.
Okay, thank you very much. Edward, can you apply analytical procedures to audit of public sectors services? Yes, very much so. And here it is very important. But when you study public sector, you realize that it is one of the most complicated sectors to audit. They don't have systems, very arrogant, they don't care, you know. Yes, analytical procedures are very, very serious procedures because, you know, you're trying to track. Have you seen right now the management is in PAC, the Public Accounts Committee. You know, the Public Accounts Committee bases on the report from the Auditor General. So when the Auditor General analyzes and realizes that things are not working well, they issue a report. So in their opinion, they issued that these guys in Mulago Hospital spent money where they don't have any account, there's any source document at all. And there was a spike in their OMM payments, you know, like, now this is analytical procedures, okay? Edward, what happened is that those guys in Mulago Hospital, the previous year, I don't seem to have the figures right, but let's say the previous year they spent 3 billion in electricity. Then the next year, they spent 6 billion. So when you analyze, you do your analytical procedures, you see that the electricity bill has doubled. You get what I'm saying? It has doubled. Then there should be, in your mind, professional skepticism as an accountant, as an auditor, you're like, what could have caused the double utilization of electricity by the hospital? Are there many people coming through? Because when you look at, for example, when you look at in 2020-21, there were not so many COVID cases as they were in 2020. So you would expect the electricity usage in Mulago in 2020 to be more than what it was in 2021 because of the ventilators that were used during COVID. You get what I'm saying? So you have to have all that knowledge when you're doing those analytical procedures.
Yes, sir.
So it so happens, have any bills? Okay, sorry about that. They didn't have any bills, neither did they have any receipts. So it is a pointer. You get. So Edward, those are the analytical procedures. So those are the analytical. Does it make sense, Edward?
Yeah, really.
Yeah. Okay, so I think, yeah, they said sanitizers. Okay, yeah. Remind me of interim financial information. Interim financial information is like you give tentative, a tentative financial statements. For example, if your accounting period goes for 12 months, and let's say it's Jan to this information be from Jan to June, or for example, if you're being audited and then you have your interim financial statements, right? They are not final. They are only final when they have been fully audited, yeah, and cleared by the auditors. That's when we say those are final accounts, yeah. Nelly, I don't know whether that is okay. You only picked what, Nelly? Yeah, it's not final. Yeah, that's what I mean. It's not final. For example, at the end of the year, we as businesses will prepare financial statements, right? But they will only be final when they have been by what has been issued. For example, first a regulator and also published in the newspapers. Is that okay, Nelly? Yes, Arnold. Yeah, Arnold, you have a question, yeah? You can ask Arnold. Arnold at Hewa. Your hand is up. Okay, maybe it was a mistake. Okay, so is there, I think that is it about these analytical procedures. Please read and read through these ratios. Read through these ratios. We put for you a solution. Okay, basically, this company, let's first go through the question. You are the audit senior of Rio and Company, and you are planning the audit of King's Construction Company, KCC, for the year ended 30th of June 2021. KCC specializes in building houses. That is very key information, and provides a 5-year building warranty. That is also a key information to its customers. Your audit manager has held a planning meeting with the finance director. Like I told you, you have to hold those meetings to agree on what you're going to do. And he has provided you with the following notes in his meeting and the financial extracts. KCC had a difficult year. That is key information. House prices have fallen, and as a result, revenue has dropped. In order to address this, management has offered significantly extended credit terms to their customers. Now that there's a risk with account receivable, the more you extend credit terms, there's a risk of non-recovery, okay? However, demand has fallen such that there are still some completed houses in inventory where the selling price may be below the cost. Do you know what that means? IS2. IS2 says you record inventory at the lower of cost or their net realizable value, right? So these guys are having a lot of completed houses in their inventory, and their selling price now seems to be lower than the cost. So there's a risk that they may not disclose that. During the year, while calculating depreciation, the directors extended the useful life of the plant and machinery from 3 to 5 years. This reduced the annual depreciation charge. Do you know what that means? They are reducing the depreciation expense, so they are overstating their profitability. So when they reduce their depreciation expense, the profitability goes up. Okay? The directors need to meet a target profit before tax of 150 million in order to be forced to manipulate figures. Yeah, they'll be forced to manipulate figures because they want to get their revenue, their bonuses. So in addition, to try and improve profits, yeah, you see, they are trying to improve profits, meaning the profits were not correct, they're not good. KCC changed their main material supplier to a cheaper alternative. That means that there is an impact with quality. Whenever you change your supplier to a cheaper one, that means whatever they are supplying you is going to have to be of low quality. Okay, this has led to some customers claiming on their building warranties for expensive repairs. You see, the poor quality supplies have affected the quality of work, and this means that the company has to come back and make repairs. So because of that, they have to provide for those repairs. They improved. Directors got 300 million shillings from DFCU Bank during the year. This
Recording in progress.
yeah, and if I am an auditor, I know the problems are also required to do. Calculate 5 years. It will assist the audit senior in planning. Using the information provided, identify and describe 5 risks and explain the auditor's response to each of the risks. Okay, so that is what I mean. Yes, so Edward, do you want to take me back to external confirmation? Is this done with notice to the client? If so, I think this may lead to conniving between the client, management, and the customer. Yes, yes, it will. Notice, you may not have notice. You don't have to notify the client. You write to them. But you know, the manager, sent a letter to a client, I just
Recording in progress.
Okay. So guys, with what I've taken you through, with the summary I've done about this question, look at it, look at the solution, compute these ratios, analyze. I want you to analyze as auditors. I wouldn't want you to discuss this question, right, in your groups before you look at the solution, okay? I want you to identify the risks and then look at what would you do if you were an auditor, okay? Just do it. Like, don't look at the solution that I've given you, but analyze it, put yourselves as if you're an auditor based on the knowledge you have gathered. The most important thing is to look out for the risk. The moment you look out for the risk, then you can easily come up with a response, okay? So this topic, then I want us to look at but no, not that. This is not it for the topic, but for that part, I want to look at another part. I believe you got the handout. Did you get the handout I gave you?
Yes, we got it.
The second one, eh?
We only have topic.
It will to 3. It has part A and part B.
When are we getting the first one?
I shared it. Boris, you're saying
We got it.
You gave us a different handout from the one you were using. I don't know when. The one I was using when. Boris, can you please unmute and you tell me how was it different? The one I gave you, the one I've just used. Pardon?
No, the PDF that you sent in the last lecture.
It's not the same.
The last lecture we're using PowerPoint. Do you expect PowerPoint to be the same as PDF? It is want everything to be done for you. And I had that outcry. That is why today I didn't use the PowerPoint. They have the PowerPoint, but because you want me to go through everything that but things are not similar. Which things are not similar? Lynette, which things are not similar? Can you tell me? Can you tell me the things that are not similar? Kindly give me an example. Guys. Okay. Okay. So now let us look at wait. 1, 2. Do you remember covering inherent risk and control risk? I need your confirmation because now you're saying
Yes, we
that things
did.
are not the same.
We covered.
Yeah, now I want to confirm because now I do you. Yeah? Do you remember looking at what? Do you remember looking at the factors that indicate risk factors that show risk.
Yes.
Okay, so this part is okay. The first part is okay. You know, you guys like to have a lot of things. I don't know why. Why do you like having so much, a lot of notes? Why do you like that? Huh? Yet you don't even read exams. I'm not going to share. I'm not going to share because when I share the PowerPoint, you start telling me, oh, things are different because the PowerPoint is here. You stay with your PDF and you read those many things. Okay. Have you guys heard of the term fraud? Of fraud?
Yes. You sent everything.
I'm not giving you two PDFs. Since mwagala bingi, nina nebirala njabawa musome. Okay. Now, do you know that when you copy, you're committing fraud? Fraud is an intentional act. Is an intentional act by one or more individuals, yeah, with an element of deceiving to obtain unjust or illegal. You're lying your prospective employer that you are a student, yet in reality you're not. So they give you a job, they leave someone who has gotten a C. When you reach there, you know, don't think that a fraud there is only someone who has stolen money. No. Even you guys who copy, someone copies from year 1, year 2, year 3, and they get a good grade. They go into their graduation parties. They start saying, oh, you see, these lecturers didn't like us. They used to give us hard things, but by God's grace, I was one of the best students. Deep down your heart, you know you are copying. You are a fraudster. And fraud starts with the smallest things. Someone who steals a pen, you know, do you know those people who steal pens as they're passing by your desk, they get your pen? That is how it starts. It starts slowly by slowly. By the time you grow up, you have become an expert. Yeah, it's different from error. Error is unintentional, but fraud is intentional, and fraud is done by people who are experts. You know, someone will take something away from me and you won't even tell that they have taken it, and they will remain the same. So we look at misstatements due to fraud. Like I said, they are into, you know? So an auditor is meant in the financial statements. That's why you always hear about big monies being stolen. But it doesn't mean that there were no small monies being stolen. They were there, but they were immaterial. Why waste a lot of time on that? Though, when you have to be very careful with someone who steals small monies. That involves the most complicated fraud is that one that involves management, because they are very sharp. They know how to manage it. Are you seeing my screen, guys?
No.
We are seeing, but we're not seeing what you're explaining.
What I screen?
No, topic 3, auditing, risk and management assessment, part B, but it's not open.
It's not open.
Not open. Not open.
How about there?
Okay, now it's open.
Yeah, now.
Okay. So, but you've gotten what I've told you about fraud,
Yes.
right?
Very well.
Yes. Okay. Has 40 days. Let me give you an example. When I was still in finance, I'll tell to auditors before you talk to manager, you don't talk to the auditors before you talk to me. Because me, I know how to handle them. I know what to tell them. Because, you know, auditors are very tricky and auditor treat it differently and he will insist on it. Yeah. So because me, I had an auditing background. So before, for example, if an auditor says we need to see the payroll, I will have to first go through the payroll with the human resource manager because the human resource manager does not, the way they will respond is not, they will respond, if I must say, carelessly. You get what I'm saying? So that we're hiding something, but you have to be mindful of what you are saying to auditors. So you get what I'm, so what I'm trying to show you is that if you find someone who has ever practiced accounting, auditing, they can easily manipulate figures. Theft of like cash inventory. People are thieves. People will steal markers. People will steal paper. People will steal. Even some people steal chairs. Some an employee, you know, these employees are no involved in small frauds, like, you know, embezzling, they go banking it, like inventory. Some of them even sell data. For example, when you share, you see, like here I'm teaching you, I'm lecturing you, but I cannot present, I can't show you financial statements of this company, even if I would even if I would really want to exhibit something, but I wouldn't show you because that is data for this. If I use data for this company to I want you to learn, that will be fraud. I am using the entity to pay for goods they have not received, you know, fictitious, you paying to fictitious vendors, using assets of the use. For example, a vehicle to come and teach MOOCs. Yeah, because my company does not benefit from me teaching at MOOCs. Are we together? Even now, I'm seated in my office, but I'm not using company data. That I don't want to misappropriate assets of the company. But fraud, there are two things. There are basically two theories. There's what we call a fraud triangle and a fraud diamond. But here we shall only look at the fraud triangle. The fraud triangle is looking at, like you do a triangle, then on the other side there's pressure, opportunity, and rationalization or justification. Most people commit fraud. For example, managers will commit fraud because they have pressure to meet targets. Yeah, because they fear for their jobs. They don't want to lose jobs. You know, so they will falsify financial information in a quest of meeting the PBT because they don't want to lose their jobs. That is financial statements fraud. But of you who are commit fraud because you are living beyond your means, you are under pressure. you have a lot of debt. You went borrowed 40 million shillings, you bought a Subaru. You earn 1 million shillings. The bank deducts 500,000 from you. That means you're left with 500K. You're living in an apartment in Naria, high end. You have to pay 1 million shillings. That Subaru you are driving, it consumes fuel. Fuel now is very expensive. You use 500K. When you have a vehicle, it pushes you to go to hangouts you don't even have to go to. That is all pressure. You want to impress a girlfriend who is not your level. Yeah, you want to show her that you can manage her. You will have to give her money upkeep every day, which you can't handle. How will you manage all that? You will end up stealing. That is pressure, right? Another one, opportunity. The controls of the system are not working effectively. The body is weak. The internal controls are weak. The systems are weak. Money is kept there. People say, but you say problem. So I have to pick space in the internal controls. It is an opportunity, an avenue for a fraudster to steal. Are we together? However, if someone is not meant to be a thief, if they put money there, they won't take it. Okay? So someone has his means, he's a cash, and he happens to get cash of 1 million shillings. Why? It is a way. Most companies should not be receiving cash. It should desist from cash transactions. Let transactions be in form of checks or electronic transfer. But if there's a weakness and this person who has a problem, he has not paid, he has been thrown out. He happens to be the cashier, and a client comes says, I can't take this money in the bank. Then the guy, because he has problems, you say, you give it to us. He won't bank that money. He'll keep that person as a debt in the books. Then it comes to rationalization. This person who has taken this money will be like, no, I'm only borrowing this money. I will take it back. Bad things look good. He has done something wrong, but he tries to justify it. I am only taking what I deserve. They pay me little money. What am I supposed to do? Like some of you who copy, you rationalize, you justify, you say, I'm not even the first person. Am I the first person to copy? Everyone here in mobs copies. So it is not a crime that I'm doing it. So these factors, we call them motivational factors, motivating factors to commit fraud: pressure, opportunity, and rationalization. They lead people into committing fraud. Whose responsibility is it to prevent fraud? An auditor. It is the responsibility of those charged with governance, that is management and the directors, to prevent and detect fraud. A manager has, the rest of the people would learn from that. But if you as a manager, you're the same person who is unethical, you're stealing from the business, people would think that it is okay. You get it? The thing is that you have to establish an internal audit function that will be reviewing the effectiveness of to obtain reasonable assurance that the financial statements are free from material misstatements, whether caused by fraud or error. Is there a risk of not detecting material misstatement? Yes. One, these frauds involve sophisticated schemes. Like I told you, these frauds are done by smart people. A fraudster is a smart They are done by guys who Jamwa. Does anyone Jamwa
We
was
don't.
Yama was an MD of NSF. MD is he's an FCCA, fellow of Chartered Certified Accountant. SCCA. He's a very intelligent guy. He masterminded a fraud. Do you know Kazinda?
No.
Have you heard of the?
Yes.
Have you heard of the OPM?
Yes.
That was also a very smart person. So a fraudster is a very smart person who can come up with a sophisticated scheme from the start to the end. And what they do, they don't rush into things. They take their time. And normally, they don't commit this fraud alone. They commit this fraud with other people. There is a lot of collusion. And fraudsters are so manipulative. They are so manipulative. They are so persuasive. They can easily persuade someone to join them. Yeah? Management is in a very top position to commit fraud. So as an auditor, as you are auditing, you must maintain a lot of professional skepticism. Let me give you an example of, and I will use an example of Mansour, because I know Mansour how. The last time I saw Mansour was small, right? So if I am auditing where Mansour is working, the first time I see him, he is small, you've just left campus, you don't look that good, the type of clothes you know what I'm talking about. All of a sudden, I go back after 2 years auditing. Mansour is the cashier. When I look at the payroll, Mansour is earning 1 million shillings. Mansour, sorry for you, we shall sort it out. Mansour is earning 1 million shillings. Big in size. He's putting on suits every day, He's cruising in a fuel guzzler, a 3,000cc vehicle. He's hanging out in the places where I hang out. I've worked for some good years. And it doesn't add up, When I add 1 to 1, there's no way Mansour can finance that kind of lifestyle. That is called professional skepticism. I am thinking out loud. I have that element of doubt. Now, don't say you always suspected him. I'm just giving an example, So what I'm trying to say is that as an auditor, if you are to pick fraud, you must have that element of judgment, You maintain that professional skepticism. You must inquire. You must inquire from management. Yeah. Yeah. Someone is saying Mansour can say his wife puts money in him. Yeah. That second one I won't say. But yes, it's possible. But that doesn't mean that I just leave it at that. Okay. So when you're auditing, you must be smart when you're auditing, especially where it says that there's an element of fraud. Yeah, so ladies and gentlemen, I would like you to read about this compliance of laws and regulations. I want you to read about corporate governance, yeah, and the principles of corporate governance, the function of the audit committee, advantages of the audit committee. Yeah, then we shall start from responses of ancestry. But when you read these things, then in case there's something you've not understood, you will question, you raise the question in the next lecture. Okay?
Okay.
So, ladies and gentlemen, yeah, and we shall touch base in the next lecture. Mansour, I'll give you a call. Okay?
All right. Thank you so much.
kale kasita naye akyakuŋŋaanya bintu nange kangira engeri gy'oŋŋambye gy'owaakaŋŋamba kati nange kamalirize wano lecture biki naye nga eri online ndi waka.
Thank you so much for watching. Make sure you subscribe to the channel.